Welcome. Thank you for participating to our webinar today. I'm Laura Baldin, Head of Marketing and Sales for Ginvest, and here with me, Filippo Lanza, founder of Numen Capital and portfolio manager for HI Numen Credit Fund. So today we have a lot of things to talk about, Filippo, and our question mark, the first one is, are trend paused or near to a stop? So I let you explain what you think about the market today.
Hi, good morning, everybody, and thanks for taking the time. I'll make it brief so we keep some time for any Q&A which is coming up. Obviously, the main focus now is COVID, and that's what we keep on thinking about, both for our personal life and for our portfolios. I think whatever the different scenarios are on COVID, I think they are getting tested and validated or not every day with the new information coming up, especially as most of the Western world is effectively going back to some sort of, normal level of economic activity with all the schools open. So our view on those is effectively there are two big scenarios. One is the one we always believed in since it came up, which is that COVID eventually be under control. And we give that an 80% probability. There is no silver bullet. We think vaccination is probably going to be at best first quarter of 2021, but some good news could come before. I think overall the protocol is improving, the distancing rules are improving. There is a lot which is actually working, and maybe the virus itself is decreasing in its power. I am not an expert by any stretch of imagination, but obviously what we monitor is backward. We're looking at the death rate, then we're looking at the IQ occupancy rate, and then obviously we're looking at the hospitalization rate. If I look at all those numbers, whether it's from China to US, the number seems to be very high in terms of testing and positivity, but disproportionately low on the end of the spectrum, which is the worst outcome, i.e. death rate and hospitalization and intensive care, which is good. Now, the 20% probability we give to the virus is the virus gets out of control. Mortality rate goes up, contagion spikes, and we need to have some more lockdowns. And I think lockdown will be the most dangerous part. Now, our feeling about the market right now is that the market is overpricing the status quo, which means this kind of lingering state of expectation of like, let's wait and see some more numbers. And I think the reason why we're saying that is that if we think really the COVID is going to be under control, although it's going to be taking some time, we think the market is too long fixed income, especially risk-free, with a lot of negative rates, or the vast majority of fixed income inside 1% yield. And there's a lot of sectors which is being really destroyed because of that. And at the same time, technology valuation are very, very high because rates are going to be low. So that we're a little bit worried that if COVID really is not a problem, or it's becoming less and less of a problem, then I think the portfolios are or the market consensus is a bit skewed. Conversely, obviously, if COVID is totally out of control, then the real question we need to ask is, are we going to see a repetition of the March-April movie? I.e., yes, we have a shock, but then we buy everything because it's a massive injection of liquidity. We think yes and no. Yes on the big economies, no on the smaller one. There will be a lot more discrimination this time. And the key thing for us about COVID is that COVID is just one of the problems. The biggest issue, which is part of our title, is that COVID is nothing else than a temporary event. Yes, we'll have more viruses because deforestation, pollution, and overcrowding in the city. That is a done deal. I think we need to expect more, and I think we'll have those protocols in place. But the real problem for us, if I look as an investor and as a long-term investor, if you want, picture, is that the COVID is effectively turbo accelerating two of the most disturbing trends we are seeing right now. The first one is what we call the technological winter. Basically, because there is a lot of COVID is effectively pushing everybody to work remotely, but that means that the unemployment structural rate will go up because technology is replacing a lot of people, and that is not going to come back, number one. Number two, because of that, there is structural deflation. If the structural deflation rates goes down to zero, which means then any startup with a business plan where they make money in 10 years will PV that as if they were now. which then means there's a lot more investment in technology, and that's the real issue, that we see technology having a productivity level which is incredibly higher than even a year before or 2 years before. So what it means is that we keep on having capex, which is highly, disruptive. Think about Snowflake versus Amazon. There's a lot of businesses that are actually going to be disrupted because there's more and more investment into technology, and that's unstoppable. And if anything, COVID accelerated that. The flip side of that, which is kind of intertwined, is that obviously, the income inequality is going up because middle class's wages are effectively getting destroyed. The value and the quality of the employment and the pricing power of that is going down. And I think that pushes the government to do more welfare, and that is going implication long term, obviously. And the short-term implication, obviously, are, in our view, income inequality, political pressure, social unrest. It will be an impact on trade. It could be an impact on the political picture with U.S. election. We've been talking for a long time about parametric chances, which is something which was created by the Latin. But I think we're moving increasingly to a place where, there's going to be too fast a displacement of labor by technology and capital, not to create big waves, big repercussions. I think, the one thing that we want to keep in mind, obviously, is that there's a lot of reaction from the government. We've seen a lot of those happening in the past with Brexit, with the Trump election, with more populists, with trade constraint. At a minimum, we would expect globalization to be under threat. Maybe that we see more of a splinternet, like TikTok being, effectively, banned from the US. Maybe China tomorrow is going to be banning Microsoft as a retaliation. We don't know, but I think that we will see more and more. The problem we've seen with this crisis, as opposed to 2009, is that in 2009 we had fiscal austerity. This time we had fiscal expansion, and of that, the most aggressive, because all the fiscal expansion is being spent to do wage subsidies and spending for income and salaries. So there's been no capex invested by the government. So that is increasing the deficit GDP quite aggressively and worsening the debt GDP dynamics very aggressively. We put a few names here. We put the classic, there's all focus on Italy and France, United Kingdom, South Africa, Brazil, Turkey. If we move to the next page, the real issue for us is that central banks want to create inflation. Governments need inflation. The population, to a certain extent, need a repricing of the inflation to move away from assets inflation into more wage inflation. And then has been a failure so far. The market, although may be calling the bluff on some of those central banks. Now, our view, and has been the same for some time, but within the Fed, ECB, and BOJ are very secure for now. If they impose yield control, it'll be very easy for them to defend it, at least for a long period of time, maybe 1 or 2 years, unless the picture changes. But we think because the increasing leverage and in debt is massive and is way bigger than what the QE is absorbing, even through the new plans, even through the rollover of the holdings, at the end of the day, there will be central banks who will be called to the bluff. And it could be very big central banks like China or Bank of England, and that's the worst case scenario. Or be smaller, like emerging markets, could be Turkey, could be South Africa. But overall, we think the level of indebtedness are going up very, very fast. And obviously, the biggest pain risk for this market is inflation. On that, we think there is structural deflation coming from technology, but we should not underestimate the power of fiscal spending to create some short-term inflation, the power of deglobalization or trade impairment or to create inflation, and also our experience, especially in Europe, but true for the rest of the world, of the state control and state involvement with economies. It's quite inefficient in the long term, and that creates inflation itself. So obviously the biggest pain risk that we see in the market right now is inflation. We think is more theoretical than not. We think there's going to be bigger risk before. And the biggest risk we see before is that either the market will call the bluff on some big central banks, or the market will call the bluff on some big business proposition and companies, either because they are fraudulent and you can only keep them up to a point, like Wirecard, an extreme example, or because their business model is becoming, very much under threat by competition, or because their zombie economy, they're being kept with rolling out their debt for too long. If we then move to the next page, obviously we spoke about income inequality. You all hear and learn about that. I mean, to us, it's going to be a big driver because one of the big issues of income inequality is globalization. We all believe in the David Ricardo kind of very optimistic view of globalization as a Pareto optimum. Everybody gets better. It's totally untrue. It's not true, and a lot of people are getting much worse off, and I think politicians start noticing it, and hence Brexit and trade wars, and I think we'll see much more of that, and that would create a lot of issues. I think Splinternet will be one of the aspects and one of the reaction to deal with income inequality, which could create a lot of tension, especially on the market. And I think if we go to the next page, on this one, we actually want to emphasize the issue of the market. Obviously, the market has been very strong, but the strength has been pretty much and disproportionately concentrated on very few stocks, whether they're Microsoft, Google, Amazon. The reality is the overall market, as we go higher and higher, is becoming more vulnerable. I think fixed income is very exposed to any kind of spike in inflation, any bluff being called on any central banks, any credit deterioration on their debt GDP dynamics, and any kind of credit deterioration overall across different sectors or corporate groups. And if you look at the overall market now with a long-term investment horizon, you need to think you're going to make returns, and a lot of people need to make returns of anywhere between 3, 4, 5 up to 10%. You need to make those returns when the overall fixed income give you less than 1% return, where you need to take a lot of risk to go up the yield curve, and at the same time, equity valuation are you can look from a very different point of view, but they're only cheap truly if you look at them versus rates, which then goes back to rates again as the main driver of valuation for the last 10 years. On that, I would add that there is a lot of liquidity trapped into this big mismatch between assets and liabilities. I think banks, there's going to be a brutally negative reconnaissance of that mismatch. Banks are, the NPL is going to explode in the next 2 years because of COVID and because of technological winter. We think, banks will have a very hard time, trying to recover and to go back even to the local highs that we've seen in the last 4 or 5 years. I think it'll be a very difficult time. We think commercial real estate, if it becomes the issue as we think it will become, probably going to be way worse than subprime. So that's a big mismatch. And another big mismatch we see is across the different funds that we see, ETF, UCITS, thematic fund over concentrated on the same bets. And obviously, recently we've seen it. There's been a pretty much direct impact of income subsidy and salary subsidy being translated into retail participation, which is great because obviously has created a buffer, a portfolio effect, which in a way has made the recovery better than expected in a way because it wasn't being modeled. But at the same time, obviously now we have an all-time retail participation as well, which is done at the click of the mouse or better at the face recognition of an iPhone. So I think we could see a lot of trading volumes coming from there. And so when we look at the market, and we intentionally use the picture of the Chinese dam, which was supposed to last for centuries and is already showing the first cracks. I think the market is very much probably the most vulnerable we're seeing, and that's since the 2009 time. I think the market is very vulnerable, and the mismatch between assets and liabilities is way worse than in 2008 and 2009. If we then move to the next page, so how are we going to make money? We are happy this year. The performance has been good. We really think this has been a turning point for our strategies. We think, like we said, the structural trends that we see as the real disruptor for the market and the real source of profitability for us, those have just been turbo accelerated. What we thought would have happened in 5 years has effectively happened in 9 months because of COVID. And the second, third wave we don't need to be worried about the second wave of COVID in our view. We think it will be probably more manageable, hopefully, and that's what we hope rather than believe. But what we need to be really worried is the structural second, third wave of the trends that we're seeing, which are, first of all, technological winter with structural deflation, and then secondly, the state response, which has been locked down for COVID, but it will be probably even more damaging in terms of reducing the structural deflation coming from technology, with increased welfare state, with more reduction of globalization and more issues on the trade policy. So volatility, macro volatility has definitely been a source of revenue this year. We've done almost probably half of the performance so far has been on that. We think volatility is here to stay, like we said. We think there is a lot of leverage in the system, and that leverage is having negative marginal impact on growth. And that cannot be dismissed, because it means that whether it's Argentina restructuring the bonds when go up 10 points and then currency adjusted their leverage shoot up 20 points. So whatever they gain, they lost it within 2 weeks. I think we're going to see more of that coming up, and that will create a lot of volatility, because leverage and mismatches of asset ability to create volatility. So we are naturally prepared for that. Obviously, we've been doing option strategy for a long time. It's been quite disappointing in the last few years, but I think now is something that definitely worth to look at and be ready to spot the best shorts in terms of the macro side. Then at the same time, obviously, we're prepared, like in April, if there is a violent response from central banks, to actually use that. And we're very discriminatory in terms of which central banks will be called upon their bluff, and they can still win because they can put so many chips on the table that eventually you withdraw, versus the ones that don't have unlimited chips and they cannot really withstand the bluff being called. And we think in the next couple of years we'll see many more central banks succumbing to the market, which will be a big surprise. The second point, obviously, is credit shorts. I think this year we had quite a few. I think there's a lot of businesses really challenged right now. Some because of COVID. We've been involved obviously with Ryanair, American Airlines, duty free. Some are zombie companies that have been pushed up their accounting forever. I think Wirecard is the extreme kind of criminal extreme, but there are many others like that. Business that no sense to trade at 20 times EBITDA in 2025, and a lot of that is accounting. Now that will come down as cash flow don't show up in the next few years. Obviously, we've been very. You need to be patient. As you've been patient with the fund, we've been patient with some of the position. Wirecard is one example that eventually worked out after 2 years of painful, waiting when you need to keep on self-doubting yourself. But I think now we are monitoring a lot of companies. There's a lot of companies that have a lot of issues, and the vulnerability of those companies is very high because investors cannot take losses. They don't have the kind of carry, the kind of return to absorb losses. So the overreaction on the bonds will be brutal. At the same time, there's a lot of business that will be challenged. They will be impaired. There's a lot of business that are there only because they managed to refinance aggressively over the last 4 or 5 years. There will be a big redirection on that, and we are looking at many sectors on that side, on the short. At the same time, obviously, the only place where we see the opportunity for equity return comparable to the last 10 years is probably going to be stress distress. We had our chunk of names this year where we could have almost triple-digit return. Obviously, we're very diversified, but I think we will see more of that where we think there's going to be businesses which are challenged, their capital structure is unsustainable, there is a bad event, market totally overreact, and then you can pick up something really cheap and then get out. The perfect example has been for us, Wirecard. We always thought the company was a fraud. We think the recovery rate is only a function of the ability of the bondholders eventually to kind of get some legal claims from some of the stakeholders been involved in this debacle. But we have a situation where we've been trading the convertible versus a massive short on the equity. And we had a point where in the midst of the crisis, the stock moved from 100 to effectively 0 within 4 days, and the convertible moved from 80 to 5. Now 5 is the wrong price because if you've done the work before, you know that the legal recovery rate could actually be 20, maybe 25. Maybe you get lucky and you get even more of that. So when it went down to 5, actually we bought and then we sold it straight away at 15. Now, those are extreme situations, you know, that we've seen it before, and our view is that we'll see more of those, because invariably you will have a lot of bonds, a lot of companies which are effectively owned by funds and by asset managers. They are not prepared to own them. And that's when we will see the overreaction. I've seen that many times in my life. I've seen it with ProSieben in the 90s. I've seen it with Parmalat in the early 2000s. I mean, we've seen it recently with Wirecard. There will be plenty of good opportunities. So I think stress and distress is something where we are beefing up our resources. We're spending more time and budget on the research side. We think it will be fantastic opportunity there. The last point which I made is obviously on equity. There's will be plenty of M&A. Like we said before, M&A typically is defensive, and it will be even more defensive now with COVID. We'll see plenty of spin-off, faster restructuring, mergers, acquisition. I think Europe will be much more open to allow the consolidation of national and European champions. At the same time, we will see more and more Europe, US, and Asia being very much siloed. So we can't forget about big cross or global mergers. I think those are part of the past. If anything, they're short if they are announced. But we will see much more, you know, consolidation. Names like Fiat, Peugeot, where we played. LVMH, Tiffany is probably one of the few that will work out. Having said that, obviously, and Bayer is a perfect example these days. M&A typically is the beginning of the end. You know, you do M&A because you can't grow organically, and those typically offer great shorts. Like, for example, we've seen it with Bayer Monsanto, we've seen it with ThyssenKrupp now recently with the disposal of the Lift. Businesses that do M&A typically are businesses that can't do otherwise, and so there's a good signal for us to, you know, then feed the strategy number 2 about credit shorts. On the equity side, like we said before, and I think we can go and maybe to the next page. It's something we keep on telling investors that, listen, you know, this peak in the market for us is remarkable because it's made of very few companies, and they're all trying to sell us the same subscription product to the cloud. The competition they're getting is massive, and most of these companies, whether it is Netflix, Microsoft, Apple, their growth expectation is based on a global economy. They may not be there. So when we look at these companies, we look at their tax rate, their regulation, their regulatory environment. I feel that if that is what has been driving the market up so much, then we need to be really, really careful. And like we said many times, you know, Amazon has got the biggest market share on the clouds, about 50%. Then we know it's unsustainable. And e-commerce is not something where you're gonna make money. So our view there, I think, you know, this technological wave is going to keep on coming, but sometimes it's difficult looking at the listed market. But the army of startups, of very well-funded, super capitalized startups, unicorns or not, it doesn't matter. But startups are actually going to disrupt the market as we know it. It's going to be very, very high. And I think, you know, a lot of the trade war will actually be the battleground would be the regulation and taxation of these big tech giants, which is very important for us, obviously, from a market point of view, because if any of those names get, you know, handicapped in any way, I think it could trigger a very big revaluation of the overall market and the asset allocation. So those are the strategies. Yeah, I mean, we're really excited about the fund. We think it's a great time for us now to look at different opportunities. These, you know, on the stress and distress, obviously, like I said, very difficult, very risky in a way. So obviously we are super diversified on those with very small single position. But I think you can look at some of the yield to maturity of some of the bonds and the current yield. And for us, that's a starting point. Obviously, we need to make sure there are enough catalysts and the capital structure is truly sustainable. But as I said before, if we can get in after the event has happened, and we're confident with the credit valuation, then they're very good picking. You don't need to be pre-positioned before. You just wait for the bad event to happen. You've done the work, and then you come in hoping there's going to be enough value in the company to allow a successful restructuring that shift value to the bondholders. Those are some of the examples. Like I said, you know, there's going to be, you know, the triple B, double B market has never been as big as now, whether it's Europe or US. Valuation of them mostly are very, very overvalued. So we tend to have shorts on the triple B, double B space, which is still trading as, kind of more investment grade than anything else. But at the same time, we're very active whenever something happens to assess the possibility of a successful restructuring. And those are some of the names we've been playing or been involved. Some we exited, some we still have them, where I think that there is definitely positive upside in terms of the future. If we move on, I think telecom, we remain very convinced that that's a great sector to be invested. We think there's going to be more M&A to consolidate it. Europe is desperately in need of that. We think telecom and infrastructure in general will be a net beneficiary of re-regulation of internet giants that use the capacity, but they don't really either pay taxes or pay the utilization rate. So we think those could actually be very much on the positive side of that repricing. It'll take time. So for now, probably best to work on the credit side or some special situation like events, like Telecom Italia Risparmio, like we've seen with Altice, that eventually got effectively taken private. We think there'll be plenty of opportunity there, both on the credit and equity space. And it's probably one of the few sectors where we really think the barrier to entry is quite high, valuations are quite low, and they're still very cash flow generative. And we do expect a very supportive environment from a political regulatory point of view. So we really like it as a sector. It's still one, probably our most strategic long exposure is in telecom infrastructure at large, especially if we see positive events. On the short side, like I said before, banks are definitely something we're negative and we're short. I think we underestimate how big banks are in commercial real estate and in SMEs, and how much of that has been totally repriced, especially commercial real estate. We think there's going to be plenty of NPL growing everywhere in the world. There may be some kind of buffer created by the authorities, but we think overall they are a very good shorts in credit, especially because a lot of the credit bonds actually benefiting from the Bund -50 for the pricing in Paris terms. We remain very short UK banks because of Brexit and because of their exposure to Hong Kong via Standard Chartered, HSBC. We have other more cyclical credit shorts. Like I said before, I think COVID is not an issue per se, but I think the damage is going to be long lasting. And I don't think we're going to go back to pre-COVID either growth or employment level. And we will have to price a lot of other issues coming up because of the COVID and because of the populist reaction. We have big shorts on some of the yen. If I look at the countries overall globally, that's where the GDP has exploded. And like I said before, it's not fiscal investment long term, it's fiscal investment for expenditure. I think of that, Turkey, South Africa, Brazil, a very exposed position. We are short, we're structurally short those names. We've been training them around. We're positive on the year since we put them on. Obviously, our P&L went up and down, so they're a bit volatile. But I think, those will be the first ones that the market called the bluff on. And again, if you look at their debt GDP, currency adjusted debt can move, double digits in a matter of weeks. And like we've seen before, there's a massive depreciation of currencies. Specifically for Turkey, we see plenty of geopolitical risk already around that. And I think, those are the names that we do want to have a short on. And it's going to be a pretty structured one, similar to the banks. On the consumer cyclical companies and some specific stories, like for example, we like LVMH, just to give an example. Great company, but obviously, they're exposed to a lot of the, issues that we're seeing right now. We think LVMH will lose the battle with Tiffany. They'll have to buy them, and it's going to be a very pricey acquisition, increasing leverage. We think LVMH is a perfect short to be short a lot of things. So we are short the bonds outright. Is a nice way to be short via both the Bund and the credit spread, which is, doesn't really reflect the exposure of these companies to a lot of products and services that could actually see a massive decrease in demand, whether it's diamonds or watches or other items. Obviously, we have other shorts, like for example, Atlantia, in Italy on the infrastructure side. We try to be short names with lots of potential leverage and revenue headwind, and at the same time names where I think overall the valuations, where is bond or CDS, they just, you know, they are too high, and the cost of carry to be short now is quite low. So we can still afford to have a relatively diversified short base.
Cool. So I think we covered all the argument, and so I would open up for question. In the meanwhile, while we wait for some question from the audience, Filippo, of course, into the latest many years, we were used to single shock and then the market going back very fast and start the trend again. So what do you think would be the catalyst today for an investor to understand that this time might be different?
I think it depends very much where the earthquake is starting, and who's dealing with it. So my view has always been that the central banks have infinite ammunition theoretically. It doesn't really matter if they go mark-to-market losses. Those are irrelevant. You know, that doesn't really matter. What the problem is that the second effect, and typically the second effect for central banks activity is either inflation or currency. So if I think about the ECB or the Fed or even Bank of Japan, I find, you know, obviously we can have, you know, in that 20% scenario, we can have a bad COVID development in the next 2 or 3 months, another massive lockdown, in which case, obviously, these guys will have to inject more liquidity, buy more assets. But at the end of the day, I think they are in a position where they can do it, and it will not necessarily have an impact on their either inflation expectation, probably not if it's a supply shock, or currency in a meaningful way. And all of those net, apart from the US, are kind of exporting big macro blocks, both Japan and Europe. So I think if we see another kind of big event, as long as it's the Fed and ECB, you may have a bit of a repeat of the move in March, April. Obviously, the timing is what matters. Are you going to buy the equity at 20% down because you know this time they have no other choice but buying equity, or because buying equity is such a difficult step for them, they need to see equity down 40%? Obviously, I don't have a crystal ball, but that would be the most important question I would ask. I think the issue becomes a lot more difficult for either big countries which are exposed to their currency and they need the currency because they're net importer, or where they have a lot of controls on the capital balance of payments. So, you know, that is a tricky group, because obviously you can have some of the emerging market country, but you could also, you know, think, you know, of big macro blocks like China, where they're not really free to let the currency move without big impact on the financial system. So that, I think, is one of the issue we see. Now there may be crises, as always we think with the old hat. I don't think the next crisis is going to be COVID driven. I think the next crisis may be very much driven by, you know, commercial real estate or a sector, credit sector, becoming really impaired because, you know, the debt level explode and there are a few, you know, blowout in it, and it becomes a real issue for the banks exposed to them, or an emerging market country. So I think the next crisis will be very potentially different, and that's my point, that at the end of the day, the Fed and the ECB and Bank of Japan will not act, and so far they have not really acted as a lender of last resort to the world, apart from the swap line, which are not really, you know, a structural solution. So, you know, I think, you know, like I said, I only see a safe haven of those 3 big macro blocks. Away from there, I think, you know, the vulnerabilities start growing.
Okay, we have a question. So the question is on Brexit. Of course, every day we have a new piece of news on this. So just an overview on your opinion for Brexit, and how and if we want to try to gain from this situation now.
Yeah, I mean, I'll make three observations. One on the, the Brexit per se now is less of an issue, I think, both for Europe and UK, obviously, because the state involvement with the economy, the removal of state aid, and the support from fiscal and monetary authority that we had from when Brexit was announced to now has made Brexit kind of less relevant. It will be another hit for which, in a way, both sides of the equation are prepared to support, whether it's fisheries, whether it's other sectors. So that is a danger, obviously, because it makes the negotiators less compelled to find a solution. Two, there is a political issue, which is obviously there's a lot going on. Europe still need to finalize the recovery fund. There's a lot of moving parts and offsetting negotiation there. And obviously UK, Brexit has been a very dividing issue. And I think there are two opposite solutions. One is, okay, fine, let's find some deal with Europe because it's too bad to manage without. The other maybe we really want to become the new Hong Kong now that Hong Kong is not around. So let's be let's move out from Europe. Let's completely create a new kind of economic environment, which will be great in 5 years, 10 years, but it will be probably painful now in the beginning. So those are my two observations, which then go back to the third one. How do we position? At the end of the day, I think the main position we have is short UK banks, which haven't really moved with Brexit. I think those are exposed to a very leveraged system to commercial real estate, and a lot is exposure to Hong Kong and global trade. So I think Brexit has been a very minor moving part for them. We still have some UK CDS, which frankly, for where it's marked, I think is the all-time low, and I think it's very much not far away from German level. So I think the upside we see there is probably much less on the downside. I think on the upside as well is probably more moderate, because obviously, whatever happens, the first instance will be a massive, monetary and fiscal reaction. So I think it probably will be, even the sell-off, if anything, will be very muted. Now, my view overall, and is that at the end of the day, there will be some sort of a fight, some sort of agreement. But being a political situation, you could never know. One thing I can say, obviously, that the political escalation we've seen in the last few months has been quite substantial with the market bill the UK decided, Europe, initiating the procedure on that, and obviously the time frame is very limited. Like we always said before, and we cannot be right, but without making any money, is that you always, at the end of the day, the default is WTO. You need to do something to avoid that, and doing something is much more complex than doing nothing. So I think we will see. But in terms of position, we still have some of the position on. We don't have anything outright on the sterling, and maybe something that we put on later on. But I think my main concern now is on banks. I think banks are very overvalued across in credit. And that's where I see the second wave of the COVID economic impact coming. And it's not just UK, it's everywhere. But I think UK, that's where we see a lot of the exposure to real estate, commercial real estate.
Okay, another question is on the structure of the market and on the liquidity risk. So this is something you touched many times in the past. What do you think about the liquidity of the market and the fact that this UCITS daily liquidity industry is quite big today?
I think the March, April it was a little bit like December 18. We had a big test. But people really, froze. But at the end of the day, it was so short-dated, they didn't even trigger the dynamics of the outflow. So I think those products will be tested when there is outflows. And I think, what I can say now is obviously the UCITS daily is very big. The notes, credit link note rather than, asset management notes is massive. ETF, thematic funds. And on top of that, obviously, the retail participation. I think in one way, obviously, we have a financial, leverage, a contractual leverage, which is much lower than before. But I think, the mismatch between assets and liability is bigger. So what is the ultimate effect? I think it's quite bad. I think, again, the structure of the market being most of financial investors based in what I call the risk-free kind of, monetary jurisdiction like US and Europe and Japan, you should feel relatively confident. I think, the only way where their market structure will be tested, I think, will be either on specific situations, some credit, some high yield, it could be some emerging market stories, or globally, if for whatever reason we see, global trade being really impacted ferociously because of populist agenda across the world, and or splinternet with regulation and taxation of tech giants, then at that point we'd have inflation. And then if we have inflation, obviously, even if it's at 2.5%, 3%, even temporary, I think the disruption on the market will be brutal on assets. And that will be the real test, I think, for a lot of these structures. But like I said before, I think, if you look at the embedded duration of your fixed income portfolio, it's never been as high as now, ever in the history of humanity. And at the same time, you have this massive mismatch between assets and liabilities, which obviously liability are kind of daily overnight, and then the assets are very, very long dated. And on average, I think, the duration has expanded for the issuer, but they must have expanded for the investor as well. So yeah, I think potentially is a big issue. I don't think it's an immediate issue. I think at the beginning it will be much more, sector or geography specific, unless we have inflation. I'm not a big believer of inflation. I think I'm a believer of structural deflation on technology, but you can stop that. You start getting a massive welfare state, inflation will come. So it depends how we're going to see it, but I think it will take some time.
Good. So at this point in time, we don't have other question. We hope that this was useful and that we were able to give a little bit of the positioning and of the view of the market. So thank you, Filippo, and thank you everyone for participating.
Grazie, thank you. Thanks everybody. Thank you guys. Have a good day and good weekend. Ciao Laura, ci sentiamo dopo.
Sì.